Look at this number, 5.2%. That does not sound terrifying. It does not look like a crash. It does not look like a bank run. It does not look like a guy in a suit sweating through a press conference while pretending everything is contained. It is just a yield, a boring little percentage attached to a boring government bond issued by the most powerful country in the world, bought by pension funds, insurance companies, banks, foreign governments, and people who use the phrase fixed income allocation without immediately falling asleep. But here is the problem. When the 30-year US Treasury yield breaks above 5.2%, it is not just a bond market story. It is a mortgage story. It is a stock market story. It is a housing story. It is a retirement story. It is a government debt story. And whether you own bonds or not, this number quietly walks into your financial life, takes off its shoes, sits on your couch, and starts changing everything. Because the 30-year Treasury is not just another asset, it is the long-term price of money. And when the long-term price of money rises, the entire economy has to be repriced. For years, people got used to a world where money was cheap. Mortgages were cheap. Corporate debt was cheap. Government borrowing was cheap. Tech valuations were cheap to justify because future profits could be discounted with tiny interest rates, and everyone could pretend a dollar 10 years from now was basically the same as a dollar today. It was beautiful. Also insane, it was like the entire economy went to an all-you-can-eat buffet called 0% interest rates, stayed for 15 years, and then acted shocked when the bill finally arrived. Now the bill is here, and the bond market is the waiter. The mainstream explanation sounds simple. Yields are rising because investors expect higher inflation, or stronger growth, or fewer rate cuts, or the Federal Reserve staying tighter for longer. And sure, that is part of it. But the deeper issue is much uglier. Long-term bond yields are rising because investors are demanding more compensation to lend money for 30 years to a government that is borrowing aggressively, spending aggressively, and rolling over old debt into a much more expensive interest rate environment. In normal human language, people are asking a very uncomfortable question. If I lend the US government money for 3 decades, what exactly am I being paid for the risk? And suddenly, 4% does not feel like enough. 4.5% does not feel like enough. Even 5% starts to look like maybe the minimum emotional damage fee. That is why 5.2% matters, not because it is a magic line. Markets do not explode because a chart crosses one number. This is not a video game boss level, but 5.2% is a signal that the bond market is no longer politely accepting the old story. The old story was US debt is safe, inflation will behave, deficits do not matter much, and buyers will always show up. The new story is maybe buyers still show up, but they want to be paid more. And that tiny change is massive because when yields rise, bond prices fall. That is the first thing most people misunderstand. A treasury bond sounds safe because the government is unlikely to default in the traditional sense. But safe does not mean the price cannot punch you in the face. A 30-year bond is extremely sensitive to interest rates. Depending on the coupon and structure, a 1 percentage point rise in yield can translate into a double-digit price loss. Roughly speaking, long-duration bonds can behave like slow-motion tech stocks when rates move against them. So the person who bought long-term bonds because they wanted safety can open their account and discover that their safe asset has apparently decided to cosplay as a collapsing growth stock. That is the first layer. The second layer is housing. Mortgage rates do not move perfectly with the 30-year Treasury, but long-term Treasury yields are part of the gravitational field. When long-term government yields rise, mortgage rates usually feel the pressure too. And this is where it hits normal people, because the average person does not care about Treasury duration. They care about whether they can afford a house without having to sell a kidney, start a side hustle, and marry someone with rich parents. At a 3% mortgage rate, a home can look expensive but survivable. At 7% or 8%, the exact same home becomes a financial hostage situation. The monthly payment explodes. Buyers disappear. Sellers refuse to lower prices because they are still emotionally anchored to 2021, when every house with a roof and a working doorbell attracted 12 offers and one guy willing to waive the inspection because he felt good vibes. So housing freezes. Owners are locked into low mortgage rates. Buyers are locked out by high monthly payments. Builders face higher financing costs. Real estate agents start posting motivational quotes. And the whole market becomes a staring contest between people who cannot afford to buy and people who cannot afford to sell. That is what a high 30-year yield does. It does not just move a chart, it changes the math of shelter. Then comes the stock market. This is where things get really uncomfortable. Stock prices are not just based on earnings, they are based on what investors are willing to pay for those earnings. And what investors are willing to pay depends heavily on interest rates. When Treasury yields are low, stocks look more attractive by comparison. If safe bonds pay almost nothing, investors are pushed into risk assets. That is how you get people paying extreme multiples for companies promising profits somewhere in the glorious distant future. But when a long-term treasury starts offering 5.2%, the conversation changes. Suddenly, investors can ask, why am I paying 40 times earnings for a stock that might disappoint me when the US government bond is offering more than 5%? That does not mean everyone sells stocks instantly. Markets are not that clean, but it does mean the hurdle rate rises. The price of hope goes down. Future profits become less valuable today. Speculative assets become harder to justify. Companies that depend on cheap capital start looking less like visionaries and more like extremely confident people running up a tab at a bar they do not own. This is why higher long-term yields can pressure tech stocks, real estate, private equity, venture capital, and basically anything valued on the idea that tomorrow will be rich enough to forgive today. For the last decade, the market loved future stories, AI stories, growth stories, disruption stories, total addressable market stories, stories where profitability was always just around the corner, like a friend who says he is 5 minutes away but has not left his apartment. But high long-term rates make the market less patient, and when the market gets less patient, fantasy gets repriced. Now here is the part that should make everyone slightly nervous. The US government itself is also trapped in this math. The United States has more than $35 trillion in federal debt. Not million, not billion, trillion. A number so large it stops feeling like money and starts feeling like someone fell asleep on the keyboard. For years, that debt was easier to manage because interest rates were low. The government could borrow cheaply, refinance cheaply, and run massive deficits while the bond market mostly shrugged. But when old low-rate debt matures, it has to be replaced with new, higher-rate debt. That means the interest bill rises. And when the government spends more on interest, it has less room for everything else unless it borrows even more. So the loop becomes dangerous. Higher deficits require more borrowing. More borrowing requires more bond issuance. More bond issuance requires more buyers. More buyers may demand higher yields. Higher yields increase interest costs. Higher interest costs make deficits worse. That is the loop, and it is beautiful right up until it starts eating the budget. This does not mean the United States is about to collapse tomorrow. That is the lazy internet version of the argument, usually presented by someone selling gold coins, survival food, or a paid newsletter with 17 urgent alerts per week. The US dollar is still dominant. The Treasury market is still the deepest bond market in the world. The US still has enormous economic power, but dominance does not mean invincibility. The scary version is not a sudden default. The scary version is a slow repricing of trust. Investors do not need to panic. They just need to demand more yield. Foreign buyers do not need to dump treasuries. They just need to buy less enthusiastically. Domestic buyers do not need to disappear. They just need to say, sure, we will fund this, but the price is 5.2%, maybe 5.5%, maybe higher. That is how financial pressure often works. Not like a lightning strike, like a ceiling slowly lowering. And history has a few warnings here. In 1994, the bond market suffered a brutal sell-off when rates rose faster than investors expected. It was called the Great Bond Massacre, which is honestly a very dramatic name for something involving fixed income, but it fit. Bond investors learned that safe assets can still create very unsafe losses when interest rates move suddenly. Then, in 2022, the United Kingdom gave the world another reminder. Gilt yields surged. Pension funds using liability-driven investment strategies came under pressure, and the Bank of England had to step in to stabilize the market. Different country, different structure, different crisis. But the lesson was the same. When long-term bonds move violently, the damage does not always stay inside the bond market. It leaks. It leaks into pensions. It leaks into banks. It leaks into mortgages. It leaks into government budgets. It leaks into investor psychology. Because bonds are not some side character in finance, bonds are the plumbing. And when the plumbing breaks, everyone suddenly remembers they live in the building. So, what does this mean for your money? First, cash finally has competition value again. For years, savers were punished. Keeping money in cash meant earning basically nothing, while asset prices went vertical. It felt like being responsible was a personality disorder. But in a higher yield world, cash and short-term bonds can actually pay something. That changes behavior. Investors become less desperate. They do not have to chase every speculative asset just to avoid earning zero. Second, debt becomes more dangerous. Credit cards, auto loans, adjustable rate debt, business loans, refinancing risk, all of it becomes more painful when rates stay high. The people and companies who borrowed assuming cheap money would come back quickly may discover that hope is not a repayment strategy. Third, asset prices become more fragile. High rates do not automatically crash stocks or housing, but they remove the cushion. They make valuations harder to defend. They make mistakes more expensive. Fourth, the old retirement math gets harder. A 5.2% yield can look attractive for retirees who want income, but if inflation remains sticky, taxes eat returns, or bond prices swing, it is not a magic solution. Retirement does not become easy just because the coupon got bigger. And fifth, the economy becomes more sensitive to time. When money is cheap, people can delay consequences. Governments can delay. Companies can delay. Households can delay. But when money is expensive, time itself becomes expensive. That is the uncomfortable truth. A 5.2% 30-year Treasury yield is not terrifying because it means the world ends tomorrow. It is terrifying because it means the free money era is not quietly returning just because everyone wants it to. It means the market is asking harder questions about debt, about inflation, about deficits, about valuations, about whether the last decade was normal or just one giant low-rate illusion that made everyone look smarter than they really were. And maybe yields fall again. Maybe inflation cools, growth slows, the Fed cuts, and the bond market calms down. That is possible. But even if yields fall, the warning has already been delivered. The market has seen what happens when the world stops assuming money should be free. And once that belief cracks, it is very hard to unsee. So here is the real question. Is 5.2% just a temporary scare in the bond market? Is it the beginning of a new high-rate world? Or is it the first warning sign that the entire financial system built around cheap money is being repriced? Drop your take in the comments, because the scariest number in finance usually does not arrive with sirens. Sometimes it just shows up as a boring yield on a boring bond and quietly changes everything. Thank you so much for watching. Please comment, like, and subscribe if you like our video. Hope to see you again.